So we have already discussed that banks create money. Now, banks cannot create money at their own will. A big part of that is your state bank, which is your central bank. So in Pakistan, we have the State Bank of Pakistan, who will set the reserve requirements. Moreover, there are other functions of the state bank. Number one, they are bankers to the government and other banks, which means that only a bank can create an account in them. As a private citizen, we cannot go and open an account in the State Bank of Pakistan. Plus, they are the regulator and supervisor of the payment system, and they are the lender of last resort. A lender of last resort means that it will provide funds to troubled banks and that cannot find other sources of funds. That's why your State Bank of Pakistan makes sure that the other banks do not default. Moreover, it's the holder of gold and foreign exchange reserves. And lastly, it is the conductor of monetary policy. So it's going to set the interest rates in the economy in order to achieve macroeconomic goals and objectives that include price stability and economic growth. So now your task is to go to the State Bank of Pakistan website and look at the introduction. So over here they have mentioned that it was incorporated under the 1956 State Bank of Pakistan Act, and they have also given over here the objective. So it mandates the bank to regulate the monetary and credit system of Pakistan and to foster its growth in the best national interest with a view to securing monetary stability and fuller utilization of the country's productive resources. Moreover, they have given the functions of the State Bank of Pakistan over here in detail. So I want all of you to go through these functions over here and read them, and so that you have a better understanding of what are the responsibilities and roles of your state bank. Monetary policy. What is monetary policy? Monetary policy involves central banks' use of policy instruments to influence interest rates and money supply to keep overall prices and financial markets stable. So monetary policy has two components. One is the interest rate and the other is the money supply. Now, monetary policy can be expansionary or contractionary. By expansionary, we mean that it is accommodative, it is easy, and basically the quantity of money, the money supply is going to increase in the economy. So in expansionary policies, basically the government is trying to boost the output of the economy, for which they are increasing the money supply and the credit so that there is more investment in the economy. On the other hand, you have contractionary. Now, contractionary is restrictive and it is tight. And in this, the government focuses on reducing the quantity of money and credit in an economy. So in contractionary, they're not trying to boost output, they're trying to do the opposite. So they're trying to decrease the amount of investment, and basically they're trying to decrease the pace of growth in the economy by using contractionary policies. Now, over here, you can see that the connection is between interest rate and money supply. So first, we are going to discuss how both of them are interrelated. So for that, you will have to understand the demand of money. Now, the demand of money is influenced by interest rate. Over here, you can see in this graph that the interest rate and the quantity of money that is demanded has a negative relationship. That means whenever the interest rate is going to go up, the quantity demanded is going to decline, it is going to reduce. Now, in order to understand this, let's assume that the economy has only two types of investments. So either they can put their money in a saving account, or they can use a current account. Now, the current account will provide more convenient transactions, but you will get no interest on it. Whereas in the saving account, the transactions will not be that easy because you cannot withdraw money whenever you want. But over here, you will get interest payments. Now, this is an economics trade-off. So as the interest rate increases, the opportunity cost of not putting your money in the saving account and using it in your current account increases with it. So as the interest rate increases, people would want to save more. They're going to save more, and because of that, the demand for money is going to decline. And as the interest rate declines, people will be more willing to use that money in their current account, and they would not want to put it in the saving account. So in that case, the demand for money is automatically going to increase. So I hope this is clear, because the relationship between money demand and the interest rate will be an important part of our story of monetary policy and the State Bank of Pakistan. The State Bank of Pakistan has some tools that they use to control the monetary policy. Now, we're not going to discuss all of the tools, but these are the three most commonly used. So reserve requirement, open market operations, and the policy rate. We have already discussed the reserve requirement a bit in our earlier video, so we're going to continue with reserve requirement first. Reserve requirement is a percentage of depository institutions' specified liabilities which must hold as reserves with the central bank, usually at zero return. So this is a percentage of the amount that the banks have to keep as a reserve, and they cannot use it for loan purposes. So they cannot use that to give out further loan. Now, if the reserve requirement increases, what will happen? That more balance will be held at the central bank, which means that there will be a decline in the loanable funds. And if the bank has lesser funds to loan out, then that would mean that lower credit and the money creation will slow down. And it will be vice versa if the reserve requirement decreases. So if the reserve requirement is going to decrease, then there will be lesser balance held at the central bank, and there will be an increase in loanable funds, which will cause an increase in the money creation. Moving ahead, the second is open market operation. Now, open market operation is the purchase and sale by the State Bank of Pakistan securities in the open market. So basically, the State Bank purchases the government securities from the banks. Now we're going to again take an example. So how is this going to work and have an impact on the money supply? So let's say the State Bank of Pakistan is going to buy government securities which the banks hold. Now, because they are buying the government securities from the bank, they're purchasing them, so they will have to pay the banks. So buying means that the State Bank is going to pay the other banks. Now, the other banks have now more money, and they can use that money to give out more loans, which will mean that there will be more money in the economy. And vice versa, if we think about the other way around. So if the government wants to sell securities, that means if they are selling, the other banks will have to purchase them. And if they're going to purchase them, money will flow out from the bank and it will go to the central bank. So they will have then less money with themselves, and there will be a decline in loanable funds, and automatically there will be a decline in the money that is being created. So now, if there is a decline in the money created, that means that that is a contractionary policy. An increase in money creation means that it is an expansionary policy. Then the last tool that they use is the discount rate. Now, discount rate is the interest rate that banks pay to the central bank to borrow from it. So if the banks want, they can borrow reserves from the central bank, and the borrowed reserves are counted as reserves that can actually back loans. So that means that more loan can be given out. Now, if that is the case, then if the discount rate gets lower, that would mean that the banks will borrow more from the State Bank of Pakistan, because it would be more feasible to do so. And that would mean that there will be an increase in reserves. And if there is an increase in the amount of reserves, I should write reserves over here actually. So if there is an amount increase in the reserves, that means more amount can be loaned out. And that would mean that, again, there is more money supply now, and this is an expansionary monetary policy. So these are some of the tools that are used to have an impact on the money supply, which in turn will have an impact on the interest rate. That is now what we're going to discuss, that how are both of them connected, and for that we're going back to the original graph that we had studied. So we have already studied that the interest rate and the quantity of money, the money demand, have a negative relationship, because as interest rate increases, people tend to save more because they will get higher income if they save, and when the interest rate goes down, they are ready to consume more of the money, and therefore the demand increases in that case. Now over here you have the money supply. So where the money supply interacts with the demand curve, where supply and demand are equal, that is your equilibrium interest rate. So this is your equilibrium interest rate. Now assume that using all of the tools that we have discussed, the government uses them and the money supply actually increases. So maybe they use the reserve requirement, maybe they changed the discount rate policy, or they used open market operations. Basically, they increase the money supply using these tools. Because of that, now the market equilibrium has changed. Your interest rate has actually gone down. And similarly, if the money supply is actually decreased, that means that it will shift this way, then in that case, your interest rate is going to increase. And if the interest rate increases or decreases, automatically all of the tools that you're going to use for your treasury operations, it will have an impact on the interest rate being charged over there as well.